Hello everyone, Abdurrahman here again. So today we'll be looking at mathematics of finance. Because in finance we also do calculations in finance. Definitely, you have to be a good financial manager. You have to do calculations. Anyway, so we are looking at mathematics of finance today, or financial mathematics as you may call it. So another financial mathematics of finance, we are going to look at simple interest. Simple interest, as we know, so what is interest in the first place? Interest is a compensation for the use of fund for a specific period. For example, you approach a particular bank for fund. Definitely, they are going to do what? They are going to charge you interest for that fund you have borrowed. You have got there to do what? To borrow from them, from the bank, or from any other financial institution. So by that, therefore, the interest that the company involved is collecting from you, is putting on you, can be seen from two perspectives. This interest a company is charging you, the financial institution is charging you, or the rate of increment on a particular fund you are using, is it consists of what? Two elements. The first element of the interest, that is the interest you are being charged. The first element of the interest is what? Compensation for the length of time the money is borrowed. Because you have borrowed the money to be used for a particular period of time, in which such a money can be used by the company that is borrowing, that is giving it to you, for other viable projects in which it's going to bring back some return to the company. So therefore, an element of the interest you are being charged, that you are charged, is for compensation for the length of time the money is borrowed. At least for the period in which you are going to hold the money. For the money not to be used for another purpose, that is one of the interests. That's part of the interest you are paying, which is also known as price of time. Also, we also know what opportunity cost. That is the cost in which the benefit in which you have lost, alternative forgone. At this other opportunities in which you can invest the money in which the person giving you the money was not available for him to use. So this alternative forgone, that's the opportunity cost. So you have to do a certain part of the interest is relating to that. Also, the second part of the interest is compensation for the risk that such money will not be repaid exactly as promised. If you say you are going to pay back the money for a period of, you want to use the money for a period of 5 years, or as the case may be, there's an element that you may not pay out the money as at when due. So therefore, another element of that interest is the risk that such money will not be repaid exactly as promised. You also know as price of risk. I will say that simple interest that we are talking about, it is computed on the principal. It's computed on the principal. That means you multiply the principal by the rate of interest. By that, you have the interest in which you are charged. And when we say simple interest, it means when we are charged that interest on it, you withdraw the element of interest from it. It will not be included, it will not form part of the capital. you withdraw the element of what of the interest on it. So they are charging another interest to be what? Be on that capital itself. So on and on and on like that. So that's what I mean by what? By simple interest. And the formula for computing simple interest is, we have this now. So let's now look at the formula for computing simple interest. Let's look at the formula for computing simple interest. The formula is what? Simple interest. Simple interest is equal to principal times rate times time all over 100. That is what you can have this as formula 1. So the future amount, at least you want to know the simple interest, the interest on what? On the principal you are collecting. So principal times rate times time. For you to know the interest, that is the time will not be what? 1 year. Okay, the future amount will now give us what? Future value or future amount anyway. Future amount of value to now be principal plus interest. Why this one is principal. Why this one is what? Rate. Why this is what? Time. Okay. So the future value or future amount is what? Future value is what? Is the principal plus the interest. So it is the interest that you have computed in the first place that you are going to be adding to the principal, to the last principal gotten. Okay. For simplification, let's look at this example. Example. For simplification, let's look at this example. Set assume the current salary. Assume the of the civil servant, salary of a civil servant is 500,000 naira, as the case may be, per annum. What is his salary? What is a salary? Salary in the following 5 years. In the following 5 years. If there is an annual salary increment, if there is an annual salary increase of 20% on a simple interest basis, on a simple interest basis. Okay, we are told to do what? To compute the salary in the following 5 years on a simple interest basis. There's an annual increment of what? To the salary increment annual on what? Of 20%. Now, assume the current salary of a civil servant is 500,000 naira per annum. What is his salary in the following 5 years if there is an annual salary increase of what? 20% on a simple interest basis. Now, looking at the formula I've cited here, the first thing, or if you are computing, if you are working under simple interest, the first thing you should do, just compute your word to simple, just compute the interest first. Just compute the interest. Compute the interest. So, what will now be the interest based on his current salary? So, the current salary, the simple interest on that will be what? The interest will be equal to what? Principal. What is the principal? That's 500. Times, what is the rate? 20. So this percentage is a percentage, over 100 is 100 here. Anyway. So times what? Times 1. Let's know the interest. Okay, everything by 100. So what do we have? What do we have? 500. 500 times 20, okay, divided by 100. We have 100,000. We have 100,000. 100,000. Okay, that is the interest. Now, the future value will be what to principal plus interest. So let's now look at it. Let's say we should compute for the following 5 years. The following 5 years. So year, we have year 1, 2, 3, 4, 5. So it means the money as it started from. So at the end of year 1, when we say the current salary, in the current salary, this is year 0 now. Is it current salary? Is it the salary now? What is the salary in the following 5 years? Following. Are we together? Okay. So the following 5 years, now we want to, this is year 0, which is collecting now. This is year 0, which is collecting 500,000. So after year 1 now, what will now be the, at the end of year 1, so what will now be the salary? So we have computed the interest. So it will now go at 500,000. 500,000 plus the interest, look at it, plus the interest we have there, plus 100. So now we have 600. The 600 there, I'll put another value. So in year 2, 600, bring down the 600 here, plus the interest again, 100. You have it to be 700. For year 3, 700, you bring it down, plus 100, you have to be what? 800. Year 4, 800, plus 100, you have it to be what? 900. So year 5, 900, plus 100. You have it to be what? 1 million. So, as the question goes, the question says, if there's an annual increase salary increase of 20% on a simple interest basis, so what is going to be is what? Salary in the following 5 years. So this is the computation. What you just have to do is just to do what? The first thing is for you to do what? To compute the interest element on the interest which you have computed here. The interest is equal to principal times rate times time for the first year. So you have it there in that way. So we have gotten the interest on it. So we just, no matter what, using the second formula here. So principal plus interest, 500 plus 100, which you have gotten here. You have it in that way. So you can see it is in arithmetic sequence. This is in an arithmetic form. Just adding, just keep adding arithmetic, just keep adding, keep adding the interest to the what to the principal, to the principal, and like that. If you now look at it, at the end of the year, at the end of the period, your total interest, you now compute everything 1, 2, 3, 4, 5, 500,000 plus what? Plus the initial principal. What do you have? You have 1 million. You have 1 million. So that is it as regards what simple interest. So under simple interest, you don't earn interest on what? On accumulated interest. You don't earn interest on what? On accumulated interest. We have seen that simple interest generates arithmetic progression. And this, therefore, our next topic, our next discussion, shall be centered on arithmetic progression. So, watch out for my next video on what? On arithmetic progression. And you shall be happy to do what? To be on this channel. Thank you very much.